and Bidjigal people of the Eora Nation, and we pay our respects to the elders past, present and emerging. And tonight particularly, we celebrate their female leaders and respect and recognise their connection to land and water. My name is Ali Perry. I am the Deputy Head of Legal at LegalVision, and it is fantastic to see so many female tech entrepreneurs here tonight. We're thrilled to be hosting this event in conjunction with AWS, so thank you to the AWS team who is here tonight. As a legal tech company, LegalVision is particularly proud of its industry-leading record on issues such as diversity, inclusion, and gender equity. We have a huge number of female leaders at LegalVision, both across the legal team, in managerial positions, and at the exec level. I've got some stats for you. So we've got 44%, I've got them here in case I forget, but I know them off by heart. We've got 44% of our executive team are female. 75% of our practice group leaders, which is our managing partner equivalent, are females. And 89% of our practice leaders, which is partner equivalent, are females. It's pretty impressive. And so we're thrilled to be hosting tonight with like-minded businesses like AWS and Airtree, who also understand and recognise the importance of female leadership in tech. But it's not all sunshine and rainbows, as you may know. There is still a long way to go for investment in female-led startups. I read today somewhere that 11% of the investment deals this year in Australia are for women-led startups, which is too small a proportion for me. But tonight we have a fantastic panel of speakers who are going to speak to you about the opportunities for women in tech from an investment perspective. And I will introduce the panel now. So we have Elicia McDonald from Airtree Ventures. Airtree Ventures is an early stage venture capital fund with 100 plus companies in its portfolio and over $1 billion of funds under management. Airtree is one of the largest VC funds in Australia and has been an early investor in many breakout tech companies, including Canva, a cloud guru, Go1 and Linktree. Elicia is passionate about supporting ambitious founders in the early stages of their journey and bringing wider diversity and inclusion to Australia's tech and VC ecosystem. Welcome, Elicia. Then we have Lauren Capelin. Lauren is VC Business Development for Amazon Web Services startups. She is a community strategist and disruptive innovation specialist with sector expertise in Web3, fintech, the sharing economy, startups, and early stage investing. Gen AI. Before joining AWS, she was a principal at StartMate, Australia and New Zealand's best startup accelerator, and a partner of platform at Venture Fund, an Australian venture capital firm focused on investing in disruptive financial services startups. Lauren has also served on the board of Fintech Australia. Welcome, Lauren. I should know this one off by heart, really, shouldn't I? And then we have Sian McLachlan, who is just but a fraction of her usual voice tonight. So thank you for being here, Sian. Sian is a practice leader with LegalVision's corporate team. She is our first point of contact for clients with financing or business structuring inquiries. Before joining LegalVision, Sian was a solicitor at an international top-tier firm in banking and finance. Sian has many startup and fintech clients and understands their legal needs well. She provides end-to-end guidance for companies as they scale, from choosing the right corporate structure to deciding on funding options. So this fabulous trio of women is going to speak to you about tips and tricks for capital growth. And before you begin, just want to remind you that we will be having refreshments afterwards, so please stick around for some networking and some hot food. Thanks.
Thank you so much, Ali. So welcome all. Thank you so much for being here. I'm so excited to see so many faces in the room tonight. Before we kick off, I'd love to get a feel for the room. So can you put your hand up if you are a founder? Who? Congratulations. Amazing stuff. And how many of those founders have raised capital so far? Can I get a show of hands? Okay, cool. Thank you so much. So tonight we're going to be running through, some of the ideas that we've been discussing, that female founders, some of the challenges they face growing a company. It's the hardest thing you can possibly do. And what we want to really identify and kind of draw out here is, ideas for helping you overcome those challenges throughout the journey. Because, there's a lot of people in this room today, but as Ali's talked about, the numbers just don't stack up in terms of the funding that those female founders are getting. And we want to kind of get to the core of why we are seeing those drop-off rates at subsequent rounds. So it'd be great to understand from the panel. We'll start with you, Lauren. Through your experience at Startman, Reinventure, what are some of the key hurdles that you see, startups generally facing along their journey, and the reasons for those drop-offs on subsequent rounds?
So the easy question first, you mean?
Yes, please.
Oh, good, okay.
Sorry.
All right.
You can just pick one.
No, I think, there is a lot to unpack there. I think if I look at maybe more of the early stage startup ecosystem, it's probably important to acknowledge that we have come a long way. It's worth calling out. I don't think any of us want this to feel like the same kind of advice that's been given over and over again in lots of different panels, but it is worth saying that, our ecosystem is still fairly nascent. There was, from a StartMate perspective where I was before AWS, there'd been, less than 3 or 4 women-founded companies up until 2019, 2020. So we've had this incredible inflection point. Let's call it an inflection point of participation, but I think we all can agree that women have been participating in this space for a lot longer than that. But what has been happening in parallel has been education around what it means to build a high-growth startup. And it's also worth just calling out that as a definition of what we're talking about in the context of venture capital. High-growth startups doesn't mean, fast-growing business that doesn't need that that capital injection to hyperscale. There are many different types of great, strong businesses. There are many successful examples of women founders in this country building incredible things in Australia and New Zealand, to be honest. But there is this kind of subset of a definition that we've been obsessed over the last 5 to 10 years as our startup ecosystem has scaled in parallel, which is a particular type of startup business where we're not seeing the same level of presence of women-founded companies. It's also to say, though, that we sometimes ignore the presence of incredible women leaders in those startups because we see the heroing of the founding team, which is often a guy and his best mate, or his brother, something like that. But there are often incredible women around him. So there is a generational aspect to this challenge that we are naturally dealing with. But there is a whole bunch of other issues at play around whether women are getting enough support to play in those early stages. That would mean we'll see that step change, in the next kind of wave of startups. We see hints, glimmers of promise, but I know that the data from the last year or so doesn't necessarily suggest that we've climbed the mountain and we're down the other side. We've had these really challenging periods, including COVID and the kind of bubble to the shrinking of valuations and even investment participation, things like that. So there's been just kind of knock after a very healthy period of growth for startups. But it is a reality check around what is required to build a certain type of business, and the literacy of this entire startup ecosystem on what those metrics need to look like has certainly been forming this whole time as well. So definitely not an answer at all to your question, but I think it's a level set that we need to be aware of. There's so many dimensions to this problem. There's so many parts that need to be tackled and unpicked, and it's kind of unfair to just point blank say, women aren't getting funded. We need to look at each part of that puzzle to understand where those we call them drop-off points because we assume that VC funding is the only metric for success. So there's like a whole thing to unpack there. We could go on, and I'm sure we'll touch on a few things, but maybe getting Alicia's point of view is even more instructive at this point.
Yeah, and I think we will break that down in terms of, as you've kind of touched on there, there are a subset of companies that are suited to VC funding, and it's not every company, and that's okay. But while we are talking about VC funding, Elicia, can you tell us what are you looking for when a company comes to you for funding? What are some of the key metrics?
The very early stages, obviously metrics comes into it, but mostly if we're looking at a pre-seed round, we're looking for the team, the founders, the vision of what they're building. When it comes to team, it's normally somebody with deep domain expertise, a deep connection to a problem, and a passion to solve that despite setbacks, which, as everyone in the room who's the founder or works at a startup would know, there are many along the journey. And so a lot of that is just based on their vision and then the opportunity that they're targeting. I think when we specifically talk about women, the data does show that in general, women are more conservative with some of their projections. So when you do get to somewhere like a seed round or a Series A round, typically more conservative than men. And again, this is a big generalization, but that's what the data shows. And so as an investor sitting on the other side of the table, we need to be aware that that's a problem and build that into our investment process. And so ask the right questions to understand how they're thinking through their projections. We say the only thing you know about an early stage financial model is that it's going to be wrong, because there are so many assumptions that you have to build in at the very early stages. So I think any investor that's just taking the spreadsheet that a founder's giving them and saying that's the way it's going to be, and not digging a little bit deeper and taking into account some of those biases that might be coming in, or some of those tendencies to be more conservative or more aggressive and optimistic, would be missing a lot of great investment opportunities. So I guess there's a much bigger picture of what you need to look for and how you think about that at an early stage. I know for me personally, like before I joined Airtree, I've been there 8 years now, I remember seeing a statistic that I think 3% of venture funding globally was going to women, and I was working at LinkedIn at the time, and I specifically remember drafting an email to the head of APAC saying, this is why I'm leaving for this opportunity, and this is the kind of statistics that make me feel like I need to be a part of this. We need to get more women capital allocators to start to change the narrative. It's quite depressing that you look at those statistics today and there hasn't been a big movement. Like, there's a lot of things that, as Lauren said, it's very complex and there's a lot of factors, but I think having conversations like today is all part of the solution, and talking about it and not being like, oh, it doesn't look great, so we want to sort of hide behind that. I think we need to have these conversations and sort of break down what those barriers are and how we might be able to solve that.
Thanks, Elicia. And also, great to hear that you're, such a champion of the movement and taking that leap. And I think, being aware of those biases, both on the investor side, but also, as a founder pitching, being aware of that in those meetings is obviously hugely important. I'm now going to shift a little bit. We've talked about VC funding, and Lauren, you obviously touched on it. What other kind of funding options do you think are out there that our founders should know about and be thinking about as alternatives to VC funding?
I think there's a conversation around what other options are available, but I think it's also worth just delving into the objectives of venture capital and the returns that it's expecting, because I think there is what has occurred through our ecosystem with the glorification of startups in general, and then the focus on venture capital is that it's the only legitimate pathway to building a business, but that it requires this awareness of, when we think about the pitch, I guess we're pitching our idea. We're focused on pitching the idea that we're passionate about and that we want to see happen in the world. And it's possible that we underestimate the fact that VCs are essentially capital allocators, fund managers. There's a very financial incentive that they look at everything through. We want to believe that they are, obviously VCs are there to back these incredible ideas, but at the end of the day, the primary decision axis that they're operating from is a financial one. And I'm not sure that we've fully, embedded that across, the entire startup ecosystem. I think some people are luckier than others that they can get through certain hurdles, and I think there is a gender lens to the ones that kind of sail through those hurdles because of how they sound when they pitch, for example, versus, what they're actually saying. But that idea that you need to be clear on the financial, drivers of your business and that ultimate financial return. So if you think you can take $1 and turn it into 10, for example, and you have a very clear way of demonstrating that, it may be more suited to venture capital than knowing that you could take a small amount of capital and build, a sustainable, thriving business. They're two very different and extreme, ends of the spectrum. There's a whole bunch of pathways in the middle, but I think we assume that venture capital is the only way to capitalize a business to grow. We don't necessarily always make the connection that venture capital is a way to grow your business at 10 to 15x the speed, the scale, etc., than where you are now. And that's a really, I think a lot of founders in general have that lesson illuminated to them in less than positive circumstances when they realize the pressure that they're up against, the time frames that they're up against. And it's worth that reality check. Just first and foremost, this is not about glorifying a pathway. This is about a reality of the kind of business that you're trying to build, the speed at which you're going to build it, and the kind of outcomes that you're aiming for. And maybe not not thinking that it's the best path. So that's like a little diatribe on, you know, how we perceive venture capital and the necessity of venture capital in this current ecosystem, which comes from a lack of, we've had a couple of failures. We haven't had as many as the US has had, and they have incredibly kind of challenging impacts on the people who experience them. Like, we don't want to set people up for failure, and I think there is a real risk that venture capital fund managers are setting out to avoid on all, you know, from all circumstances. This is not about setting people up for failure. There has to be a genuine belief in this kind of 10x return profile business. So that's kind of the grain of salt around who should be thinking about taking venture capital. When we think about what other capital models there are, I think it is this question of speed and scale. What is right for your business? What is the pathway you're thinking this business should go on? How quickly do you need to get there to get the advantage that you're trying to get, whether it's, you know, the first mover advantage with your customer base, whether it's the technological development that you need to establish, you know, the kind of product that you want to have in market. There are different reasons why you might want to fill the coffers with money to front load kind of that accelerate that part of the journey. But, you know, it sounds like a bit of a trite thing to say, but of course, and Elicia said it on the call, so I'm totally stealing the line that she said, but like the best way to capitalize your business is obviously customer revenue. So, you know, if you can't do that, that's when the decision around, well, why can't I do that? Because the product's not ready, because I can't reach them fast enough. That's when the decision around what kind of capital you need to accelerate that comes into the picture. And then I think that the lens becomes, well, is this, you know, a business to business type engagement? Is this business to consumer? What kinds of capital models might suit, you know, taking on a large amount of debt to front load the development because you can see the potential of very large sales downstream. You wouldn't want to take on debt capital unless you had this sense of, you know, large enterprise deals, you know, intention, you know, letters of intent don't mean a whole lot, but you want to at least know that you're going to get product market fit pretty quickly once you've taken that debt on. If you think about the other end of things with more of a community-oriented crowd fund, business to consumer type model, you want to get that engagement from your customer base around the idea of your business before you think about taking other people's money. So that could be, you know, the traditional waitlist sign-ups type engagement, the concierge model of your product. What can you hack together to galvanize enough support for your business that you could then you know, take on capital at a more conservative rate to prove out those hypotheses one after the other, as opposed to going all in and kind of raising for an 18-month journey, which may or may not play out the way you think it is. So there's a whole bunch of tiny decisions, I think, is the summary of what I'm trying to say. No business is, well, every business is so unique from that perspective that you need to be sense checking as a founder from the get-go what journey you're on. And it's not a question of ambition, it's a question of the nature of the business and the product that you're in, but having those frank conversations and having those advisors around you to help you think about what that natural end point might be is certainly a really critical part of that fundraising pathways decision-making process.
And then I think like some of those decisions you talked about, like they're decisions that every company will face, like whether or not it's VC funded or not. Maybe if we can dive into some of those. I mean, you know, like two of the most important, I think, like customer acquisition and product market fit. Elicia, it'd be great to hear your thoughts in terms of how Airtree kind of like works with its portfolio companies, helping them tackle these, you know, like, key problems in their business.
I think product market fit is one of those concepts that can be really hard to grasp. People say you sort of know when you have it. And it definitely doesn't need to be correlated with revenue. So we see lots of companies, you know, we back pre-revenue, pre-product companies. There might be a company that's pre-revenue, then launches a product, and you see that engagement. You kind of feel that customer pull. And I guess from a customer acquisition perspective, it's going to be different if you're going B2B versus B2C, as Lauren said, and there's going to be some specifics around that. I guess how we lean in on that, so depending on the company, like majority of companies that we back in our portfolio are B2B SaaS. And so even though we have sort of 100 plus portfolio companies across a whole range of industries, there's just so much connections between our portfolio companies where you can share learnings around customer acquisition, regardless of the industry that you're in. And so we do a lot to connect our portfolio companies with each others. We have executive forums across all C-suite roles. So all of our CROs, for instance, connect with each other, share knowledge and learnings. We also produce a whole lot of resources. So a lot of those we share with the broader community through our open source VC branding. But the idea is that, we produce these resources, like we might do something on sales compensation plans. So if you're starting to hire an enterprise sales team, or typically in the very early stages, founder-led sales, how do you think about, as you scale beyond yourself, building out a compensation plan to incentivize your first sales hire? Like, we'll open source a lot of those resources to share that with the broader community. So I guess there is a lot of knowledge sharing. We also have a pioneers community for women and non-binary founders, and so they're people outside of our portfolio that is really just about knowledge sharing. We just see so much value in forming connections, bringing people together, and people sharing their stories. I totally agree with Lauren that the idea of VC being this pinnacle of success, VC funding, it's very appropriate to a small subset of companies, and there's a huge range of successful companies that raising capital isn't the measure of success. It's a means to fund a certain type of business. As I mentioned on the call, and as Lauren reiterated, revenue is your way to grow your business. There's lots of businesses that would hear us talk about venture funding, and you think you just run a profitable business. You drive value for your customers, you bring in revenue. When you start to think about going down the path of venture funding and talking to someone like me, might be if there's such a big opportunity that you want to run so quickly at it that you want to build product before the revenue's there, and it just allows you to get through that period of time until, hopefully, the end goal is always to have a profitable company and be in control of those levers. But we try to profile stories of successful businesses. Like in our pioneers community, we had Verity and Hannah from Lovely. Some of you might know the flower delivery service. They sold that business for $35 million. That's an incredible outcome. So I think trying to highlight some of those success stories that may not have gone down the venture funding pathway, may not have been in our portfolio, but just starting to spread that knowledge that there's so many different versions of success. So I think a lot of it, in answer to your question, is letting that knowledge flow and not hiding these stories about the different ways to grow a successful business and find that market fit.
We have been notoriously bad at celebrating those other kinds of success stories, so it's great to hear what the pioneers community is doing. We haven't heard about hundreds of the women business owners who've had incredible outcomes through different means, because we have more of this startup ecosystem narrative. So I think that is a really important point.
Yeah. No, I definitely echo those thoughts. And I feel like that it is entering more and more of the narrative. I think people are starting to recognize this shift. It's just because we don't get 10, 100x, if we get 2x, that's, in a lot of cases, that's an incredible outcome. Something that's kind of come through is like you were talking about what Airtree do, is building that network, and it's definitely something I think I see a lot from some of the male entrepreneurs that I talk to, and I think something that I do, I think that's something that, maybe something that females can kind of lean into a bit more. And I kind of you hear about guys getting by because they know their mate here or they know their mate here. Lauren, how do you think that female founders can use that more, whether it be from their service providers, their funders, people in their network?
Yeah, it's so funny when you do these things, because you want to share this advice and then you're in the back of your mind going, I feel like we're just telling a whole group of women to be less ambitious than they were when they walked in here, because it's not actually what is, that underlying point isn't you shouldn't choose this pathway. It's just about, if you're committing to that pathway, go all in is actually probably the point. And so to the question that you asked, Sian, I think we women, I think, generalization, I'm going to say from my experience, we ask for a lot less help than we could. And I think there's been a lot more of the knowledge sharing that has happened informally, because there's been generations of men going through this process now. So there is, ex-founder sees young protege who reminds him of himself, and we don't have those reps in this ecosystem. So there is an element of asking for help, and who you ask help from should not be gender specific. Let's be clear. You should be asking male founder X, male VC X, women founder, women VC. But we are not good at, I think, personally, from what I hear, just to be clear, I'm not generalizing, but it's what I have observed is being crisp and clear with that specific ask and knowing exactly what you're trying to get out of the conversation. It's a very general, soft call for help, as opposed to a very specific and strategic insight around, here's what I'm trying to do. I think you can help me close this gap. Where can I lean on this? And I say this from that perspective of AWS, and what I've learned since joining the company is just how vast an opportunity there is for service providers of all different kinds, AWS included, to really get into the weeds with its customers, especially those ones who are growing at a pace, to support with customer introductions, to get deep into the weeds of the technology and to understand if what you're building is as robust as it could be, as lean as it could be, as cost efficient as it could be. And I believe that we work in our back rooms trying to get this perfect outcome, which we can then take to the world. We're a little less comfortable with the messy, let's not say build in public necessarily, but a bit more of that messy, I'm having a problem with this, or I can't figure this out, but I think this is the kind of direction I need to go in. Who can help me? Where can I pull in this advice and insights? The reason, because I think it can catch us out, we show ourselves as less presentable, less packaged up, and people will remember that and will go into pitch and they'll be like, oh, I saw them at their worst. And these are real fears, and I don't mean to suggest that it would be foolproof if we just told everyone the challenge we had and then suddenly they'd give us money. I do believe that these things can end up counting against us, but I think we need to do it more often, relying on the safer networks first and then pushing on the ones that are a bit more challenging, and holding people to account if you see help being given in different ways that you don't believe you have that same access to. So, I think that unlocking customer support, the technology, leading with that more often, I think is, I don't think Australia, as a general rule, its startup ecosystem is as strong on the technological, like the leading edge of technology, especially unless you are in sort of the deep tech end of things. I think we have a lot more commercial founders these days. There was a time 10 years ago where it was mostly technical founders, and in fact that was the bar to being a founder. That was why we had this huge gap between men founders and women founders, because there weren't as many technical women launching startups. We see the cycle repeating all over again in generative AI, but I'm stoked to see, so Shrena's in the audience. She was one of our generative AI spotlight cohort founders, who's also, a technical woman. We run the risk of having this cycle repeat all over again with generative AI, for example, if we don't see more women kind of pushing on that from a technical perspective. It doesn't mean you have to be technical, but you should go deep on the technology and know what it is you're building. And I think there's plenty of people, support networks, service providers who can be in your corner to help on that front. So leveraging those opportunities.
Yeah. And I think your point about having the clear ask and not thinking that that's imposing. I mean, I had a client, I'm not going to, hope you don't mind sharing the story, who just told me, I feel like I nag you. And I'm like, that's what I'm here for. So LegalVision, we have a membership product, and it's designed specifically so our clients can reach us whenever they need with a query. And that's what we're here. And we actually thrive of answering those queries. So you're not nagging. We're here to support you through your journey. That's what the startup ecosystem is about. Elicia, do you have anything else to add on that?
Yeah, I think from the funding lens, so if you think about the sort of connections and networks that can help you go down that path, the first step is often a family and friends round or an angel round. And so I can think of one of the women founders in my portfolio that I work with that, she's post-Series A now, but she said, before she was raising capital, people were saying, oh, you just do a family and friends round. And she's like, I don't have family and friends that can put hundreds of thousands of dollars in this business to get it off the ground. Like, who are these family and friends that people are talking about? And then she had one meeting with, it was a white middle-aged man who connected her into a pool of capital that he had all these other friends, and it got her business off the ground. And she's like, if I hadn't have had that one conversation, I was just blocked out of those conversations. I just didn't have an in, and I didn't even know where to start. And so I think there's something that, women founders, we can encourage and give tips and tricks. There's also just some system-wide things that we need to change. Like, we need more diversity in our angel investors. Like, that needs to change, and that's been woeful historically. We have an Explorers program, which is really focused on getting more angel investors, educating people who are qualified in technology and have the skills and the capital to help founders, but have not necessarily been an angel investor in the past. We run 2 cohorts a year. They're always 50-50 women, non-binary, and men. So we make sure there's equal gender representation. And so that's a really important way for us to try to diversify the face of angel investing in Australia, which is one step that we can do to try to fix that sort of first step that excludes you from some of these capital conversations. Again, nothing is a silver bullet, but we've seen some promising trends from that. We've sourced 5 investments ourselves. So essentially it's a scout network out there finding diverse deal flow for us and bringing it into our fund, because we know that we have a lot of power for capital allocation. And so none of these things fix everything, but I do think the angel ecosystem, that's the first step that you have. And if you're just not connected to the right people and don't have the wealthy family and friends to get a business off the ground. It's such a shame to think how many businesses may have been started and created that may not otherwise have happened if we just didn't have the right people to get those businesses off the ground.
And maybe if we move a little bit further along the journey, so say the female founders here, they've found funding and they're partway along, and now they're looking at maybe doing their second round. I guess we have clients who come to us at this stage, and some of the key issues that they're facing is kind of negotiating like the rights between those investors. And you've obviously had someone who's been with you from the start and backed you from the start, but you need to grow and you need to bring on new people. How do those conversations go from your side?
Yeah, so I guess the first thing is hopefully you're dealing with a sophisticated angel that knows the kind of terms that would be expected by a venture fund if they were to come in at the pre-seed or the seed round, the one after. That's a big part of our Explorers program, is educating on standard terms, on process, how to run a good diligence process as an angel, because if somebody hasn't angel invested before, we don't want really funky terms in there that then as a VC we have to come in next and negotiate them all out. It can be a really painful conversation. Often the founder gets stuck in the middle of it. So we'd prefer to avoid that by just educating the market on this is what's standard. Typically if that angel investor is good, they want their equity to be worth more over time. They want you to be successful. They don't want to stop you from raising capital. So there's generally a conversation around the edges there. If something's completely outside of market, like that just needs to be fixed, because what happens is you have bad terms in a very early term sheet or long form docs, and then it gets sort of built on round after round. And so the pre-seed investor's like, well, they had that at the angel round, and we need those rights to protect ourselves. And then the seed investor, Series A, Series B, it just creates a lot of problems, which is why it's so great to get advice from someone like Sian early in the journey, so that you can avoid the bad terms that could create a much bigger problem for you later on. Typically, we'll make sure all our terms are pretty standard. So in that circumstance, we would just negotiate out anything funky, because it can be existential to the business longer term. You might get a Series A, Series B investor that just won't invest under those terms. So it needs to be sorted, and it's best to be sorted earlier versus later. We open source a lot of our sort of standard seed stage term sheets, so you can kind of see like what a typical top tier VC like Airtree would propose at a seed round, so you can kind of get an idea of what's standard. So helpful if someone's given you terms to go, is this sort of outside market or is this standard? Refer to that as a sort of benchmark of what's standard, just to avoid any issues. My advice would be work with someone like LegalVision early, get the tips, get the tricks, make sure it's market standard, because it can come back to bite you. And if there's somebody at an angel who's giving you like pretty draconian terms, probably a bit of a warning sign as to whether you should be working with them longer term anyway. So easier said than done, obviously, if you're trying to fund your business to get to the next stage, but ideally more options allows you more negotiating power.
Yeah, and I think, and I definitely, echo that in terms of it's thinking about how those terms are going to set you up for the future, and you're not just going to think about this round. You've got to think about that for the whole stage of your journey, and think about whether it gives you that flexibility to achieve the milestones that you're seeking to achieve. Lauren, do you have any thoughts, I guess, in terms of, other than on the financing side, key decisions that the clients, founders can make that open up that flexibility for them later?
Something that I've been thinking a bit more about lately, especially, when we look at the gap between seed to Series A, like there is definitely something systemic and something that feels, more material here that could actually be changed depending on how we address the problem. But there's clearly a number of women founders that are getting backed at seed stage that aren't clearing that hurdle for Series A. Now that's a very individual investor decision, but it's happening in such a large volume that you expect there's something else going on. For me, it feels like the next layer of this, the generational learning that we haven't acquired yet, that again, there's a lot more founders ahead of us, a lot more male founders who have been able to learn from their peers, been part of high growth startups that have reached that stage, know what's expected at that round, whereas a lot of women founders going from seed to Series A are doing it for the first time without that kind of same level of peer support. So I've been thinking a bit more about, how do we start how do we raise that seed round with the Series A in mind in that sense, and work backwards from those outcomes? It's a very Amazonian kind of mindset, this notion of working backwards. It shouldn't be a mystery where you're heading, and you should be able to have almost, some degree of understanding agreement with your existing investors that if you're getting to these milestones within this period of time, then you're on track for that particular round. Obviously, you'll be introducing new investors at that Series A round. But if you can have that end in mind and focus most specifically on, especially the revenue goals or whatever it might, like the metrics change between Series C and Series A. So you should be focused 100% on those more tangible metrics. You can almost raise on the promise at a seed round or a pre-seed round, and it's very much the reality that you're raising on at that Series A round. And pulling in everything you can as early as possible to position yourself well for that round in 18 months' time, not waiting for the kind of 6 months out from when you need money to try to pull that Series A round together, which is so common and understandable. But I just wonder if there's a mindset shift around, getting a clear conversation around what that benchmark looks like, and positioning and sense checking that at every investor meeting. Are we on track? Are we on track? Look, maybe this is what's happening. Like, I have not raised a Series A round. I don't know from the perspective of a founder, but I do know from the teaching that we offer through AWS around preventative versus, the bias questions, through proactive versus preventative questioning that happens through women's investment rounds, which has come out of some Harvard studies. You've probably all seen those as well. So there is this clear sense of, what can go wrong in a women's business rather than what's going right, and what could go right if we kind of throw all our support behind it. So I think that constant sense checking around those, the difference between those two angles, and being prepared for the proactive kind of opportunistic conversation rather than the preventative defensive question mode as early as possible through that seed to Series A chasm. I really hope that we can start to see the needle move on that front. I don't know if you have any kind of direct insight from that as well, what you're seeing in your portfolio.
Yeah, I mean, I think in general, just aligning, like at each capital raise, aligning with your investors or whoever you've worked with on what you need to look like at the next raise, and working back from that makes a heap of sense. Like, we sometimes talk about, thinking about what you would want your pitch deck to say at that next round, and then what do you need to do to get back to that. Not that your whole goal as a business is to raise more capital, but if that's the path that you've gone down to continue to scale, just being aligned on that is helpful as you're motivating the team, as you're thinking through your priorities and how you set your OKRs.
Does that happen? Like, do you see that happening well, or is that a potential area where there's a gap?
I mean, founders always have so many things. They get put in so many different directions. So you're not often, thinking in detail about sort of 18 or 24 months down the track. But I think it is a useful, like, sort of reset when you're getting pulled in so many different directions. There's so much you can do. You don't have enough time to sort of break it down to, like, what's the key focus. And it is a conversation we have quite frequently with our portfolio. But obviously, there's a lot of companies in the ecosystem that haven't raised capital, aren't part of our portfolio, that might not have that somebody sort of resetting and helping bring them out of the weeds and looking at the bigger picture. So I think doing that exercise yourself around, like, what would you need to look like, and then working backwards is a super helpful exercise to stay focused on what really matters.
I might do a time check. Yeah, okay. So maybe we have time for, I guess, like one last question. So, I mean, say we are a founder and exit is what we want. So there's obviously, like, different options on the table. I mean, we're currently at LegalVision, we're actually seeing, in this cycle, there's a lot of M&A activity happening, which has been really interesting. And again, like, lots of people having successful outcomes. If you're say you are working towards an exit, what are some of the key things that you think you need to keep in mind?
So working towards an exit, the main thing is obviously thinking, like, what does that exit look like? Who could be the kind of people that you would, or businesses that you would exit to, and building relationships with those businesses early. It's not the kind of thing, particularly if ideally you're profitable. That's the best situation from an exit. You control your own destiny. You're in the best possible negotiating position. You've got time. There's less urgency. And your potential buyer universe expands a lot when you're profitable. So I think getting ready for a potential exit might be 18 to 24 months prior to that, where you're actually getting the business to the state where it is attractive, and that might be getting the profitability, making sure you're having the conversations with all the potential acquirers, might be engaging an advisor depending on the stage that you're at, or if you've got existing investors on your cap table, really leaning in on them. It's something that we spend a lot of time with our portfolio companies, leaning in on their financials. So, like, how do we get your financials to the right spot? If we can get to profitability, great. How do we make you the right introductions to potential acquirers? And that's not a process that's done in a number of weeks and even months. It takes a lot of time. If you're doing a very serious potential exit, hundreds of millions of dollars, that's a really significant process to get to the point where you want to get to that, just get acquired. If your exit is an IPO, that's obviously a whole different ballgame in terms of prepared. You've got lawyers involved, you've got investment banks involved often. So it really just depends what path you're going down. But if it's a trade sale, around the 10 million mark, it's typically something that you would be able to build relationships with potential acquirers. The potential strategics that might be interested in. I think coming back to your point earlier, Sian, around potential pitfalls early on. Taking on strategic money early, that could have blocking rights, that could come back to bite you when it's exit time. So again, just thinking down the track around how that might play out. But assuming that's all clear, it's about really making the right connections, using your network and the people that you might know to get those conversations, having materials that are clear and concise, and ideally the financials, and you're in a great spot and you're profitable. So that gives you the best possible negotiating power when it comes to negotiating strong exit.
Anything to add?
Look, it's not from experience. This is not a path that I've walked, but I think it does come back to another part of the earlier conversation we were having, is why have you set out to start this business in the first place? Even an exit, it sounds, in your mind like you cash out and you go find a beach to sit on, and I don't think that's been the reality certainly there are great outcomes where it's literally the founder handing over the keys and they walk away with their the liquidity side of things, but I don't think that's how it works out. There's like earn-out periods, there's a whole bunch of things that come along with it, and it's often, is it being done because you're exhausted and you need to find a pathway for the business that you thought was heading in a different direction? Is it something that you're really excited by, and that is the picture of success that you had in your mind? Even again, the public company side of things, are you prepared to be a public company CEO? Are you looking to hand over the reins to prepare for that kind of exit? Or are you building a business that you want to stay involved in and grow, to the degree that it's, supposed to grow in perpetuity? I think those decisions are actually really important to have that level set on at the beginning of that journey, for all the reasons of which sort of capital you take on, who do you involve in those decision-making processes early on as well. So many of these questions become about data and documents and this external version of if you are the founder, this is about you and your life, right? And I think it's really easy to that founder identity becoming the business identity and all those kinds of things that happen along the way. We want healthy, happy founders, especially the women founders who are juggling all these kind of other responsibilities. So being aware of your own motivations, being aware of the outcomes that feel successful to you, and putting the right kind of building blocks and plan in place for you to successfully achieve those outcomes is frankly all that matters. If you take on venture capital money, then liquidity does matter. So there's the choice that you've made from that perspective. If you are positioning for an acquisition and you want to hand over the reins, you need to prepare the business to be sold in that state. There's a whole bunch of opportunities in between as well. So that's my hippie note to end on, is what do you want?
Can we touch a little bit on secondaries, because I think you sort of touched on it there. So I think one thing that's interesting is if you want to keep growing that business, but you also need to put some money towards your mortgage because you've been a founder for all these years, there's also other ways to potentially take some money off the table as you go along. So it is common for founders to sell some secondaries as they go through capital raises, so that money goes to your pocket versus going into the business, and you give over some of your equity for that. That's a really good way to take some of the financial pressure off on that journey, because it can be a 10+ year journey, and life is important, and it is important for you to not be under financial stress. And so that's something that we see. And then also from a VC perspective, we have 10-year funds, so at some point, as Lauren mentioned, we do need to get liquidity. But we're getting a deeper and deeper secondary market here, more large funds from overseas investing in Australia, and they present liquidity options for us. So we can essentially sell our ownership to another investor versus the whole business having to exit. And I don't think that really was the case sort of 10 years ago. So thinking about liquidity, you don't need to necessarily exit your business to be able to get access to some of the wealth that you've built through that business.
There was a funny shift also that occurred. It used to be a bit of a dirty word to go into an investor meeting and say, oh, and here's how we plan to exit. And everyone would kind of say afterwards, oh, they were already thinking about their exit. That was not the right attitude. And I think now it's smart and strategic to have a long-term view of what that natural endpoint is for your business, or the kind of strategic endpoint. So we've come a long way, I think, is the endpoint of that as well.
Thank you both so much. We have some key takeaways, although the discussion took a very different turn to what we had planned, so I don't think these actually represent. But here are some additional points to consider. But yeah, thank you all so much. It's been such a fruitful discussion. So glad to hear, so lucky to hear both of your insights and really put a different spin on things. I'm sure it's a lot for our founders to take away, so thank you. I'll throw it out.
Thank you again. I'm sorry to stand in front of you, but it's the camera. Thank you again, Elicia and Lauren, for your insights and sharing your experiences. And thank you, Sian, for facilitating such an interesting and engaging discussion. I'm sure there are a number of questions, which we will get to in a minute. But before we do, I do want to just mention a couple of events that we have coming up. So Wednesday, the 9th of October, we have a Startup Legal Essentials, so getting your business off the ground for any of you in the early stages. And on the 23rd of October, we have the Power of Branding, so building and protecting your brand with IP Australia. It's free to register. Go to the website there, or I'm sure keep an eye out for our marketing that will be coming around. I also wanted to touch on something that Sian mentioned about we have, before I move on, we have the contacts for Lauren here. So feel free to take a photo, but we will be sending these around afterwards, so don't panic. And also contacts for Elicia. And I wanted to touch on something that Sian mentioned briefly today, and that is our LegalVision membership. So LegalVision, for those of you who don't know, is a full-service commercial law firm. We have over 100 lawyers across Australia, New Zealand, and the UK. And we help a number of women-led businesses in all sizes of organisation, from early stage startups to SMEs and even large enterprise businesses as well. Our LegalVision members have access to our lawyers, unlimited access to our lawyers, and they can we help with all businesses' usual legal needs, as well as things like disputes and transactions as well. Under a membership, you have access to unlimited document drafting and reviews, advice consultations, domestic trademark applications, employment law assistance, and more. You can all claim a complimentary consultation today. There'll be a QR code shortly that you can scan to book in your consultation. Or you can speak to one of the LegalVision members here tonight. There's Cassie and Victoria in the front, and we've also got Megan here. So there's a few LegalVision people around who can assist if you have any questions. But that's it from me for now. Does anyone have any questions? I'll come around with a microphone.
I'm interested to understand the VC space as it applies to B corporations. So obviously that's popular in America, less so here, but when your metrics are not just money but lives saved. When your metrics are not just money but lives saved.
Yeah, so a number of our portfolio companies are B Corps, which is something that is great, right? Obviously, it talks about impact well beyond the financial metrics of that business. I think if we can get to I think as Lauren mentioned earlier, like we have limited partners, like our job is to return capital to them. But if we can return capital in a way that also does good for the world, that's an incredible way for us to deploy our capital. So it's something that we would consider an investment process, but I guess we wouldn't just invest on that basis. Like we'd need to also be able to see the financial return, but it is something that a number of our portfolio companies have invested in. And it's quite a process to go through the approval of getting B Corp. I think the decision that they've made there is that it's the right thing to do for the world, but also it helps them attract top talent, retain top talent, win customers. So there's actually a really sensible business case there, and I think that's the sort of lens that we would take on it, is that that will help their business be successful because of those sort of other impacts of investing in it.
I actually ended up in venture capital via social innovation, social impact, and B corporation kind of involvement. And my motivation, similar to Alicia's, was also like women, capital allocators, and all that sort of stuff, but also thinking that these two worlds should have been closer together. And I think I've probably changed my perspective on that recently. It sounds obvious, and I sort of hinted at it, but it just really has hit me like a ton of bricks this year. That VC, literally, it's a financial incentive, and it's like a necessary financial incentive. Not that they should care about doing good and also making money, but they are literally like fiduciary. There's a fiduciary responsibility to make a financial decision there, and the worlds can mix, but they have to put that first. What I think is important is the layer around kind of pure VC, which is more of your impact investment, or family office money, where the decision-making process usually calibrates that financial return. Like, they don't want to lose money, but they're happy to balance those outcomes with other outcomes. And it's much more of like a direct decision amongst a family group, as opposed to the VCs representing their LPs, their limited partners, whose money, you know, they're investing. It's a very different decision you're making on behalf of somebody else's money versus money that's your own. So I'd be looking at that ring of the ecosystem for those kinds of the interest in B Corporation status and things like that. Not to say that there's not plenty of venture-backed companies that have not got B Corp status. Yeah.
And we do have a responsibility as having a portfolio of over 100 companies. We have a head of impact internally at Airtree. We are doing a lot of work around ESG VC, which is like encouraging our portfolio companies to think about ESG at a very early stage. They each do an annual checklist of what they're doing. And for a very early stage company, a lot of the questions they may not have thought about. And so a lot of the survey they fill in might be blank, but like we say that's okay. Like, we're doing this to actually start the conversation, because if you're not thinking about it really early in your journey, you'll turn around at sort of Series B and Series C, oh, we haven't thought about that. And we have an obligation as a VC to sort of set the standard, like, think about it. It's okay, you might not have all the answers on day one, but these are the kind of things you should be thinking about. So B Corp is one way to sort of certify that you've been thinking about that from the early stages, but there are sort of broader ecosystem-wide drivers that are happening from large funds like us to our portfolio companies.
Hi guys, I'm also a LegalVision member, so you know, you don't need marketing, just a testimonial. These guys
Thanks,
got me out of
Marina.
the pit of despair, which was having to deal with it, so thank you. I do have a question. So you did mention that there's that Harvard study around women founders getting different questions to male founders. I recently read something that if a female founder is backed by a female VC, they're less likely to be subsequently, backed by male investors. What's your thinking or take on that?
I haven't seen that statistic. Oh my gosh, I hope that's not the case. Oh gosh, that that is just sad. That's sad, and it just makes me think, well, we need to have more women VCs, so that doesn't become a problem, because you don't want that to be the reason that there's drop off. That is, I don't know. That is just, I need to sit on that one for a little bit, because that's really sad. And I think all we can do is continue to help women founders build great businesses, because it is pretty incredible that the best startup coming out of our entire ecosystem, over the last 15 years, is woman-led. Like, Mel at Canva has built an amazing business. Like, we should celebrate these wins. And I just think it's so sad to think that women capital allocators backing women founders then becomes a signal for them not to get back to the follow-on round.
I mean, maybe if we try and take a constructive spin, maybe it's thinking about, for that first investment decision, having that conversation with the investor and saying, like, this is the journey that I'm on, and maybe getting some feedback at that initial conversation, being like, after this round, are you going to be in for my follow-on? Like, are you going to be following on in subsequent rounds and backing me and introducing me to, like, other people in your network? I mean, I have to say, like, if I'm thinking like Flying Fox Ventures, which is one of the most prominent female venture funds, like, they've got lots of connections with other VC funds, and I see them co-invest on subsequent rounds. So again, very sad to hear the stat, but maybe it's, tackling that problem head on and trying to preempt that decision later.
I think that's a great point. There are definitely clusters of co-investors, and I think there can be tracks that emerge, which may not be gender specific, but there's like this group over here invests with each other, this group over here invests with each other, and it is definitely worth, in those, like the same way as you're looking at your terms, who have the people that I'm considering taking money from in those early rounds, who have they invested in, who are they legitimately connected to and can pass me through to. I think that's a really great, we even only have to look at things like the Flow Health versus Clue and, women, like femtech and things like that. There is certainly, I believe the stats, I hate to know that they exist, but there's certainly things going on. But there's ways that you yourself can stay accountable to making sure you're making good decisions for your business as best you can. Yeah.
Diligencing your investor, like you shouldn't ask questions during the diligence process, like how do you approach a follow-on round? What do you typically invest? Actually speak to portfolio founders. How did they invest in your next round? The round after that? Did they connect you to other potential leads for the follow-on round? Who did they connect you to? What did that lead to? So that you can kind of test whether the reality sort of matches what they're telling you.
Hello, and thank you to the panelists. It's been really great. My name's Nicole Gamera from My Care Space, and I'm a massive fan of LegalVision. We've been using your services for, I think, 2 years now, and honestly wouldn't be where we're at were it not for LegalVision. So mine is probably more an observation, maybe even a question for someone like Elicia. So we operate a marketplace in the NDIS space, and we're probably the classic case of what you're talking about. Don't want to ask for help. We're going to do this all on our own. And the observation that I've made is that there have probably been 2 organizations, NDIS marketplaces, who have raised huge amounts of money based on a promise. And I'm just absolutely flabbergasted. We're doing what they do, both these organizations. They've gone in with a promise, and I would just love to know what statistics and what revenue they've promised, because this has all probably happened in the last 3 years, and we're on the sidelines watching, and we're like, wait, we're doing what you're promising to do, and yet you've raised $10-15 million. So it almost seems like investors are more interested in the promise and the blue sky rather than, okay, this is the baseline, we've set the baseline, we've got an established business, and we're going to grow it with capital. No, I think my observation is that investors they just want to see that hockey stick. Am I right, or?
I mean, do investors want to see strong growth? Then yes, and I think this comes back to Lauren's point, is like our job is to invest here and hopefully return capital to our investors there. The promise at a pre-seed angel round, unfortunately all you really have at that stage is a promise of what your vision is. I think I spoke about that before. So the founding team, which is always going to be a factor, and then the promise of what you're going to deliver. So it's very hard to compare a pre-seed company to a Series A or Series B. The difference is going to be the valuation. So obviously a pre-seed is going to take more of a discount. When you're more established and you're doing it, you would expect a premium to your valuation, and so that would be taken account in that sense. I think it's just making sure that you're part of those conversations. So if you're sort of there being like, I'm already doing this, I'm already solving this problem, it's making sure there's no blockers to get in the room and have the conversations. I think the jump from sort of pre-seed, you might be pre-product, pre-revenue, to then seed, you start to have a few metrics, and then by Series A, as Lauren said, you're not promising anymore, you're actually showing it. So at that point, you either don't have the statistics to show it, and that means you go down a different path, or you do, but it means you need to be in the room. And so making sure, like a big part of why I do events like this and have my contact details up in there is I don't want anyone to not feel like they can't reach out to me or contact me, because that would be the worst answer, that you've got an amazing business and you can't speak to big Cs. That's a huge failure for our ecosystem and something that I know we all personally really care about. So I can't speak to that specific situation, but I think it's like making sure that you've got the path that makes it attractive to a VC fund. It sounds like you do. And then making sure you've got access, which I can play a role in that, but there's obviously a much broader ecosystem to make that you can raise the best possible round on great terms, which often means competitive tension and getting multiple conversations.
Obviously, I don't know enough about your specific business or the competitive landscape, so I'm just going to abstract my points. But I think there's 2 other dimensions to this which have kind of been interesting to observe over the last 10 years of growth of the ecosystem. I feel like more often than not recently, we have started to produce a number of startups that aren't necessarily like strongly technologically enabled or technologically better than others. Like there's like a lot more service-oriented businesses with some level of technical ability, but not necessarily an advantage in their technology. And I think that it's worth sense checking or doubling down on the technological advantage that your business has against competitors, because that's ultimately where we're going to see, the efficiencies, the economy of scale coming from. So if that's relevant, I think that's something that we can do a better job of telling the story of, because I don't think many founders are necessarily in the early stages leaning on that. The other part of it is, there are crowded markets or like popular spaces to innovate in, and then there's, the winner takes all kind of concept as well. So, there's in a market like Australia, a lot of the markets that we're playing in are crowded and also winner takes all. So there's this necessity to clarify and demonstrate how you are going to win it, not just be a player in it, which can be a really challenging concept, especially when everything else around the competitors is often closed doors. You don't get to see the product, you don't get to kind of see how they're building the business, but you need a compelling proposition for why you're going to not just be a worthy competitor, but be the dominant player. And I don't know if we naturally think in those terms either. We're going to be the best, not just be in the game. So I'm not sure if either of those pieces of advice are relevant, but I think it's something that is worth considering. Yeah.
Any other questions? Well, we will have some drinks and nibbles afterwards, so if you have questions, please stick around. But thank you again to our panellists for tonight. Thank you everyone for attending and for the questions to keep the conversation going. You will be sent a copy of the slides after tonight, and you'll also receive a survey, so we'd be really grateful if you could complete that. Just helps us make our events even better. So yeah, stick around, have some food and drinks.